Hello, everyone. Welcome again to the For You at Work virtual webinar here at First Service Credit Union. We are so happy that you're here with us once again. Today, we have another awesome presentation for you. We're going to be talking about something that's important to everybody, and that's home buying, home owning. Okay, so today's presentation topic is the keys to buying your next home. Okay, and this is going to be presented by our wonderful mortgage lending partner, Tammy Tapman. Tammy is great. She's the Vice President of SWBC Mortgage and VA Liaison. Tammy, welcome.
Thank you. Thank you, Ernest. I'm delighted to be here.
Welcome. Tell everybody about yourself, and then we'll jump right into the webinar.
All right. Well, I've been teaching homebuyer classes for many, many years. I'm licensed mortgage loan originator. And I love what I do. My specialty is veterans. So if there's any veterans that are listening, very excited to be presenting today.
Well, we're excited to have you. The floor is all yours.
All right, thanks. So let's talk about the keys to buying your home. Thank you, Ernest, for that great introduction. I am, as Ernest said, the VA liaison and a vice president for SWBC, the lending partner. First thing I'd like you to do is to stop and think about what are the reasons that you want to buy a home. A lot of people want to have freedom to be able to decorate their house the way they wish to decorate it. Maybe you want to attach certain fixtures. Maybe you want to provide stability for your home by living in a certain area of town. Perhaps you want to live in a school district that meets your needs. Maybe you want to invest in your future. There's this big school of thought that one of the best ways to build wealth is to buy a home. Maybe you want to take advantage of the tax deductions that are available. If you are itemizing on your tax return, you can deduct the interest that you pay on any home that you live in as your homestead. You can also deduct the property taxes. Maybe you have solar panels on the roof and you may be able to deduct those and take advantage of energy tax credits. Perhaps you have a home-based business. Home-based business deduction is available through the tax code, but you want to be sure to check with a tax advisor when you're thinking about that, rather than you can't take a standard deduction and then also itemize. Mortgage reduction builds equity. So we're going to be talking about a $100,000 example where the first lien on the home is $50,000. So in other words, you only owe $50,000 on a house that's worth $100,000. You then have $50,000 in equity, or 50% equity in your home. So as you're making your mortgage payments, you're reducing the principal, and that helps you build equity. Renting is kind of hard because I rented for several years, and every time my lease came up, guess what happened to my rent? It went up. I didn't get a whole lot more for it. So predictability. People like to own their own home because they like to know pretty much how much they're going to be having to pay every month on housing. There's a great capital gains exclusion in the United States, and that is that if you've lived in the home for 2 of the last 5 years, when you sell the house, you do not have to pay capital gains on that sale, up to $250,000 for a single individual or $500,000 for a married couple. There's no age restrictions on that. You can do it every 24 months. You can also deduct any of the selling cost and capital improvements that you make to get that house ready for sale. So there's really not a whole lot of investments where you can say that you don't have to pay capital gains, but buying a house is one of them. Equity loans. So in the state of Texas, you can borrow up to 80% of the value of your home. So taking our house that we talked about earlier that's worth $100,000, we only owe $50,000 on the home. We can then add another $30,000 on a home equity line of credit, second lien, and we can use that money that we get for anything we want to use it for. We can go on a trip to Europe, we can send our kids to college, we can pay off debt. If you use that money for home improvements, I am told that you can deduct the interest off that home improvement loan. And a home equity line of credit is a lower interest rate than what you would pay if you got financing, say, for example, through Home Depot or through a bank, or charged on your credit card to do improvements to your home. So better interest rate. And if you use the funds to improve your home, your homestead, then you should be able to deduct that off of your taxes as well. So we know that buying a home is the largest and most important investment people make. Ernest, you want to say a little bit about that?
Yeah, now Tammy, I wanted to touch on one of the points that you had mentioned on your on the previous slide. The tax benefits of home ownership, I think, cannot be understated. I think a lot of people are familiar with a lot of entrepreneurs, a lot of people in Hollywood. They always own multiple properties. A lot of times, a lot of homes that they don't even live in. But a lot of the reason why is those tax benefits that you talked about, right?
Mm-hmm. Yeah, that's a great point. I'm glad you're bringing that up. So a lot of really good reasons to buy a house, for sure. We know that it's probably the largest transaction that any individual will ever make in their lifetime. So one of the things I love about teaching this class, I've been doing it for many, many years, is we want you to feel more comfortable about going out into the world and finding a home and understanding the terms, kind of understanding the process. So the first thing that you really need to do to make it all easy on yourself is to arrange for your financing first. Now, FSCU has a wonderful loan officer, JP Watkins, who's a personal friend of mine. I actually even know his mother, who also works for our company. And he is a really strong loan officer, one of our top performing loan officers in our entire company, and we have 400 loan officers. So you're going to want to at least give JP a call, and here's his phone number, 210-581-1533, or you can email him questions at mortgage@fscu.com. And again, his name is JP Watkins. So he's a guy that you can trust. He's extremely knowledgeable. He's been around in the business for quite a few years. So getting your...
I attest to that as well, Tammy. JP is great, everybody. All our members here, he helps them whenever they have mortgage-related questions, and our members that want to do their mortgage loans, JP is our guy. So please reach out to JP. We are going to put his information in the chat as well for those of y'all that are following the chat, and you can also get his contact information from there. And with any questions you may have, if you're considering refinancing at some point as well, or purchasing, please reach out to JP for that. Okay, thank you.
I'm glad you mentioned that. Refinance, that's a good thing to mention, Ernest, because interest rates are historically lower than they've ever been in the history of the United States. So thank you for that. I had a realtor call me the other day, and she said, could you call my client? He's not moving on getting pre-qualified. He hasn't done, I've told him, I've been working with him for a few months. He has not gone and gotten qualified with the lender. Guess what happened to him? The property that he wanted to buy got purchased by someone else. His contract wasn't accepted. His offer wasn't accepted because he didn't have a pre-qual letter attached to that offer. So getting pre-qualified is not only a good thing for you to know, because you want to know if you can qualify for the house and how much you can afford, but also the real estate professionals are very, very reluctant to ever accept any type of offer that doesn't have a pre-qualification from a good lender letter attached with that. So that's what you want to do. You want to gather your information and then contact JP, go on the FSCU website, apply for a loan. And then JP, when he pre-qualifies you, is going to give you a closing cost worksheet. A closing cost worksheet is a very rough estimate of what your closing costs are going to be. So we don't know which property you're going to purchase. So, but we can give you an estimated figure of what what your closing costs are going to be. So if you ever run across a loan officer that does not want to give you a closing cost worksheet, and there are some out there, that's a red flag that they're not a very reputable person. Once we get 6 pieces of information, such as your name, your income, your social security number, so we can obtain a credit report, the address of the property that you wish to purchase, the estimated value of the property, and the loan amount you're asking for, that requires us, the lender, to give you a loan estimate. And that is a more accurate picture of what your closing costs are going to be. So under the Real Estate Settlement Procedures Act, once we get those pieces of information, which usually coincides with getting the contract, we have to give you a very accurate picture of what you'll be paying, and that is called a loan estimate. So I think, you know, as I said before, as far as is now a good time to buy, I really have never seen in my 35-year career interest rates this low. I myself am thinking about buying a house, and I'm thinking about buying a more expensive house. Why? Because the interest rate is so much lower than what I paid in the 90s. I think it was like 9% of something. So we want to take advantage of these really great interest rates because we don't know how much longer they're going to be available to us.
And Tammy, to help you with that as well, we are launching a poll right now that everyone is going to be seeing as well. So if you want to go and chime in that poll, guys, we want to just know, you know, what are your feelings right now, or some of y'all potentially going to be in the market. When may you be in the market? So you'll see this poll question, and we're going to go ahead and share the results of that poll question as well. Go ahead, Tammy, you got it.
That's awesome. You guys are so high tech. Hey, should I just take this off my screen? All right. Okay, so there's fixed rate loans where the interest rate stays the same for the term. There are adjustable rate loans. So your payment, your principal and interest payment will stay the same. You've got a 30-year loan on a fixed rate. The only thing that will adjust is if your taxes go up or they go down, their insurance premium goes up or down, then your payment can adjust accordingly. So on an adjustable rate mortgage, they usually have lower start rates, adjustment, annual, periodic, lifetime caps, and people will consider doing an adjustable rate mortgage, also known as an ARM, when fixed rates are high. So like in the 90s, we did tons and tons of adjustable rate mortgages. Maybe you're not going to live in the house very long, so you just want to make sure you have a short payment or a small payment or smaller payment. So JP can talk to you about whether an adjustable rate mortgage or a fixed rate mortgage would be something that you would be interested in. There we go. We got some more polling going on there. 58% are ready to buy.
All right, we'll be helping y'all with those. Make sure you reach out.
Yeah, this is a fun thing to do because I wish I had taken this class when I bought my house in the 90s because it can be quite overwhelming. So you have different types of loans, and mainly there's 2 types: conventional loans that are insured by the private mortgage insurance companies out in the marketplace. Minimum down payment in most cases is 5%. That PMI, the private mortgage insurance, is required on every loan unless you're putting 20% or more down. So I'm considering buying a house. I'm considering, you know, when I sell my house, I really want to put a lot of cash into that new one so that I don't have to pay that PMI. The PMI, however, goes away once you pay that loan down to 80% loan to value. And that's only on the conventional loans. But so conventional loans are insured against default in case something happens and you can't make your payment. The lender will be covered. You are not covered by this, but it helps you get the loan. PMI, private mortgage insurance on a conventional loan, helps you get the mortgage. I'm having problems advancing the slide for some reason. There we go. All right, government loans. There's two types mainly. There's a few more, but mainly there's a VA, the Department of Veterans Affairs, and then there's FHA, Federal Housing Administration. Well, the VA is for our military men and women in the United States that have served their country during wartime, and we've been at war since, or in some kind of conflict since August 2nd of 1990. So for 30 years, we've been in a conflict, and that means it's easier for the veteran to qualify as far as the number of days service. You only need 90 days in addition to your training to qualify for the VA home loan program. You can be active duty, and of course you cannot have a dishonorable discharge, but there's a funding fee that's charged, and it's a one-time fee instead of a reoccurring fee that the conventional PMI insurance is. So it's a one-time fee, and it's waived for any veteran who has any kind of service-connected disability. And so JP is very familiar with VA. He also offers a product called the Veterans Housing Assistance Program, which is an awesome program through the state of Texas. And if you have a 30% or greater service-connected disability, you can get a really low rate through the Veterans Land Board. And JP has well known for his work with veterans and the Veterans Housing Assistance Programs. That's a great program. FHA is available to everybody. It's a 3.5% minimum down payment. Federal Housing Administration was created in the 60s to help people be able to qualify for loans. And so the government is basically insuring the loan, and they do charge an insurance premium, upfront insurance premium that can be added to your loan, and it's called an MIP, mortgage insurance premium. And then there is a monthly mortgage insurance premium on an FHA loan. Easier qualifying, less stringent requirements than conventional, but you do have that MIP insurance that is stays with the loan for the life of the loan. So if you're considering staying in the house a really long time, you may want to talk to JP to give him, he can compare FHA to conventional and counsel you on which program would be the best for you. The seller can pay closing costs, and of course they have to agree to it and has to be written into the contract. They can pay up to 6% of the sales price in closing costs. So the benefits of a VA loan, just going to talk about that just a tad. Don't have to put a down payment with the VA. We can do a manual underwrite, which means if for some reason we put the information into an automated system, a computer program that for the government, like Fannie Mae's Desktop Underwriter or Freddie Mac's Loan Prospector, if we get a refer, which means they don't like the loan, we can take another set of eyes and do what we call manually underwrite, manually assess the risk. JP really believes in the customer. He can take another look at it and send it up the chain to the underwriting manager. There's only certain things that you can charge a veteran. There's lower fees, minimal closing costs with the VA loan. The thing I love best about the VA, as a daughter of a Vietnam veteran, is that you get a better interest rate with a VA loan because it is guaranteed by the Department of Veterans Affairs. So it's less risk for the investor, so it's a better interest rate. Defaulter pending foreclosure assistance. If you should lose your job, if you should have any kind of a situation where you need help, maybe you just need a one month modification. They have a special servicing unit at the Regional Loan Center in Houston that can help the veteran. And not every program is like that. If you're just at the mercy of the servicer, that can be a little tricky. Sometimes the servicers don't really do their job that well, so the VA can intercede on behalf of the veteran.
Wonderful. Now, Tammy, I wanted to also ask, I know you may have mentioned this earlier, and I learned this the hard way back in the day when I was in the market. Now, is it okay for me to, once I start an application with JP and he started the process, is it okay for me to go buy a car or go open up a credit card?
Oh, that's a really good question. No, it's not. We suggest you do, Ernest, is, once you get your pre-qual letter, please don't change anything. We had one gentleman that wanted to buy a car for his wife. So what he wanted to know, should I pay cash or should I get a loan? Well, in this setting, I can't answer that question, but you would always go back to your loan officer if something happens and say, JP, I need to buy a new car. Do I still qualify? So that's an excellent point. Once you get approved, please don't go out and charge up a bunch of furniture or open a new credit card. Thank you. All right, so you do need money. I mean, the days of where you could buy a house for $1 down, those are kind of few and far between, and unless you're buying from a relative. So it's very important for us to tell you as mortgage professionals what you need, how much it's going to cost. So on a conventional loan, your down payment is going to be 5%. So using our $100,000 example, then 5% of that is $5,000. So we'd be lending you $95,000. You divide the loan amount into the sales price of $100,000, that gives you a 95% loan to value ratio. So if you were putting $10,000, 10% down, your loan to value ratio would be 90%. So I kind of want you to know what loan to value ratio means so that you can have that terminology to impress your loan officer, but also to say, well, JP, what if my loan to value ratio was lower? Would you give me a better rate, or how would that work? These are some terms that I've seen that over the course of years of doing this class that many of our home buyers really don't know what a title company is. Title company is a company that specializes in examining the chain of real estate titles, and they issue insurance, title insurance, to the lender and to the borrower if you wish to purchase it. Your loan will be closed at a title company, and that title company will be researching the chain of title to see if there's any defects, if there's any long lost relatives that could jump up, if there's been any fraud. For example, how do we know that the seller is really who they are? So if they get it wrong and they miss something, for example, let's say the seller had some work done on their house and they didn't pay the contractor, and there's still a mechanic's lien contract filed on the property, and the title company misses that, then we have an insurance policy and they would have to make that good. So we're always required to get what we call a mortgagee's lender's policy. We can't get anything through the system without a mortgagee's title policy that shows that the title is the chain of title is good. We're the mortgagee, we're the lender, you're the mortgagor because you're taking out the loan. You can also get a title policy. You don't have to. And CFPB, Consumer Financial Protection Bureau, wants you to know you do not have to buy that. But I would definitely recommend considering buying it. It's regulated by the Department of Insurance. And so you go to one title company, they're going to charge you the same thing for the title policy as another title company. And your policy is less expensive than the lender's policy. It's also customary for the lender's policy to be paid for by the seller. Typical loan closing costs, admin fees, lender fees such as processing, underwriting, third-party fees, mortgagee's title policy, the appraisal, credit report, tax service fee, flood zone certification, attorney's fees, survey fees. So third-party fees, items that are performed by a third party. So escrowing for taxes and insurance, private mortgage insurance premium escrow, the mortgage insurance premium if it's an FHA loan, and then prepaid interest, prepaid insurance. So you would be required to purchase a 1 year's insurance policy and an escrow setup. Those are your typical closing costs. Now, most lenders are going to set up an escrow account for you, and the title company will collect 2 months worth of insurance and 2 months worth of taxes, and you will have purchased a 1 year's insurance policy, homeowner's hazard insurance policy through your insurance agency. So those things are required always on a government loan. So if it's a VA loan, you don't have a choice. FHA loan, I have an FHA loan. I don't have a choice. I have to pay every month. I have to pay the servicer 1/12 of my taxes, 1/12 of my insurance. If you put 20% or more down on a conventional loan, then you can do what we call self-escrowing, where you pay your own taxes and insurance. And I just want to say that in Texas, we don't have a state income tax, but we have higher property taxes. So you will want to check with the real estate professional, your realtor, your agent, to find out what are the property taxes in this area. You never ever want to sign a contract unless you know what the taxes are, and they should readily be able to give that to you. Escrow accounts, so they're collecting a cushion at closing, and they're allowed to collect 3 months cushion. Our company collects 2. And then every month, the payment is going to include 1/12 of your taxes, 1/12 of your insurance, the PMI or the MIP insurance if required. And then every year, the mortgage company is going to send you an escrow analysis, and it'll tell you when your loan was, when your taxes were paid, when your insurance was paid, and also what your new payment is. So 1 year, my insurance premium went up, my payment went up $5 a month. So if they have a shortage in your escrow account, if your taxes went way up, and we're seeing this too. Mine went up this year as well because property values are going up. So my tax rate stayed the same, but my property value went up. So it went up quite a bit. They didn't come to me and say, you know, Tammy, you're short on your escrow account. What they do is they just increase your payment to cover that shortage so that they'll have enough money when those bills are due. And the bills are sent directly to the lender, the servicer, for payment.
Yes, I want to receive some buffs here.
And so escrow your escrow amounts can increase or decrease depending on what your insurance and your taxes are doing. Let's talk a little bit about some lingo, some points and rates. Your rates are determined by the yield that the investors expect to make for their similar investments, and then the return that they expect to make on their money. And they receive that in the form of discount points and the interest rate that you pay. 1 point is 1% of the loan amount. So it could be paid by the buyer or the seller. You never ever want to pay points unless you are buying down the interest rate. Unfortunately, I have seen some home buyers that got ripped off by some unscrupulous lenders that talked them into paying points for a market rate loan. So sometimes if the veteran or the home buyer needs a little bit of money towards their closing costs, we can do what we call premium pricing. And in this example, you'll see that, of course, we're using our $100,000 loan amount as we've been talking about. These rates are absolutely not market. It's just for illustrative purposes. But we could charge you a little higher interest rate on this example, 6.5%. We give you 1.1% of 100,000 will be $1,000 credit towards your closing costs. A little lower interest rate, 6.375, 0.5% will be $500 towards your closing costs. 6.25 is par rate. You receive no credit for that rate. You're not paying for that rate, and you're not getting a credit. So I do want you to understand what par means. Par is you're not paying for that rate, and you're also not getting a credit. When you're negotiating rates, it's a good idea to say, JP, what's your par rate? He's going to tell you that anyway, but that'll just impress him quite a bit, I'm sure. Then you can pay points if you want to get a lower interest rate. So in this example, you pay a point, $1,000, to get the interest rate lowered to 6%. Now, what you want to know is this a good decision for me? And you want to have JP or your loan officer explain it to you. So you see for the par rate, 6 1/4, your principal and interest payment would be $621. If your 6% rate would be $605, and that's just your monthly principal and interest payment without your taxes and insurance added in there. So we take the difference between the 621 and the 605, the par rate against the discounted rate, and we're saving only $16 a month. So we take that $1,000 you paid for that lower rate, we divide that by the monthly savings of $16. That tells us that it's going to take you 62.5 months to recoup the investment. So you're going to have a 5-year term to get that $1,000 back. Is that a good idea? No, it's probably not. So these are the kinds of things when you talk about paying points, you want to make sure that the loan officer explains exactly how much you'll save and you have a good recommendation. Your monthly payment's going to include your principal, interest, taxes, insurance, PMI or MIP if that is required. Once you get to 80% loan to value ratio, you've paid that loan down 20% on a conventional loan. As long as you've been making your payments, as long as the appraised value is still there, you can ask the lender to take that PMI premium off. Once the loan to value ratio is 78%, they don't have a choice. So the government makes private industry take it off on the conventional loans, but on the government loans, they keep it for the life of the loan on an FHA loan. You can't get it waived. When we're underwriting your loan, when we're assessing your risk, underwriter's really going to be looking at four areas: the credit, how you pay your bills, the assets that you have to close, the income, the amount and stability of it, and the property itself. What condition is the property in? So if your property doesn't appraise out, the other thing I want to say about that is, that may not be a bad thing for you. If the property doesn't appraise out, that means that there weren't sales in the area of like-type properties to support the sales price. So that could be an opportunity for your realtor to go back to the listing agent, the seller's agent, and ask for a reduction in the sales price. So if you do have credit issues, and I feel very strongly about this, don't give up. It's your right as an American to own a home. No one is allowed to put a hurdle in front of you. 70% of the American public has some type of issue, whether they have too much credit or they have had a divorce or something's happened. If you wish to see your credit report, you can go to annualcreditreport.com for free and look at your credit report. The scores are not free, but I would also say to you that JP uses a different repository than the ones that you could link to off of the annualcreditreport.com website. So he's going to give you your credit scores. You go into the website and you apply online. JP is going to email you those credit scores so that you can see what he's looking at. So checking your own credit won't harm your credit score at all. Now, your FICO score is comprised of these 5 elements. First off is the payment history. How do you make your payments? If you're trying to improve your score, pay more than your minimum and pay ahead of time. 30% is the amount that you owe. So the credit scoring FICO model does not like to see that you've taken a line of credit and charged it up to the max. Their model prefers 30% of the trade line. So what does that mean? That means if you had a $10,000 credit limit, that you would try to keep it at $3,000. If you're over that amount, don't worry, but that's just a way to improve your credit score, is to have a lot of credit availability. 15% is the length of credit. Types of credit is 10%, and then new credit is 10% of your total credit score. Sources of funds can be basically anything you can think of. Savings, gifts from relatives, as long as it's documented. 401k loans, you would contact your 401k provider and they could tell you what the term of their loans are. Sale of a previous residence, sale of assets, any type of bonds, stocks that you might have. So what we do, just so you can kind of understand a down and dirty calculation we use when we're looking at your ratio, what that means is your total monthly obligations as a percentage of your gross monthly income, your income without any type of deductions. So we would take your minimums on your credit cards, your installment loans, your car loans. We would add the proposed mortgage insurance, mortgage payment with the PIT, principal interest taxes and insurance, and MIP or PMI, if that was included, and divide that into your gross monthly income. And we'd like to see that that figure is less than 38% of your gross income, or 38% or less. So if it's over 38%, doesn't mean you're not going to get the loan, but that's just a rule of thumb that we use.
Now, Tammy, I had a question, and also to all our viewers right now, if you have any questions, please put them in the chat. We're going to put all the questions together, and Tammy is going to answer those questions for you at the end. So we encourage you. We have some good questions already, but we encourage you, if you have any questions, please go ahead and put them in the chat. You can put it publicly as well as send it privately to our chat moderators. Now, Tammy, you mentioned about ARMs in the presentation, and I know that, back in the day, ARMs got a real bad rap. That's the adjustable rate mortgages. How are they now? How are you guys recommending them to individuals to use if they have to use an adjustable rate mortgage loan?
I think, JP is probably, can counsel them individually.
Yes.
It's as far as making a general statement, but I would say that most people are going to use an adjustable rate mortgage if they are trying to keep their payments really, really low and they expect to be moving soon. I know I have a friend who bought a condominium. She knew she wasn't going to live in San Antonio very long, and she got an adjustable rate mortgage. So everybody's a little bit different. I think they're going to be a lot less common in today's world, because when are you going to be able to get a 2.75 or 3% or whatever the rate is, is at the time? It's still super, super low. So fixed rates are probably going to be a little bit more advantageous in today's world. So what we want, thank you for that question though. We want you to kind of stop and assess your needs and talk to your significant other or whoever you're buying the house with, or just, stop and think, what type of house do I want? Do I want a 3-car garage? Want an island in the kitchen? Kind of think about what it is you're wanting to do. And of course, the internet really has helped us so much. Instead of driving around like I did in the 90s, so you can go online, any house that's listed for sale under the multiple listing service. In other words, it's listed with a realtor, and most houses are listed with realtors because they sell for more money and they sell quicker. So I'm getting ready to list my house, and a friend of mine said, why don't you go ahead and just do it yourself? And I'm like, no, I'm going to list it with a realtor. So you can go online and see the pictures of that property. They'll usually have a tour, a virtual tour. Maybe they might even have aerial shots. A lot of rural properties, bigger ranches, they will have aerial video that will show you what the house looks like from the air. So that minimizes your house hunting time. You can kind of weed them out that way. I think this is one of the most important slides in the presentation. You want to drive the neighborhood during peak traffic times. So go to the house you're thinking about buying in the morning before you go to work. Drive to your job, see what that's going to be like. When you get off work, drive to the house. See if you can live with that commute. Check for flooding. I would never ever buy a property without knowing up front whether it's in a flood hazard area. So if you're located in a 100-year floodplain as determined by FEMA, Federal Emergency Management Agency, if you're in a 100-year floodplain, you must have flood insurance, and that can be expensive. So how can you find out whether the property is in a flood hazard area? You can ask your realtor, and they should be able to give you documentation. You can also talk to your insurance agent and give them the address of the property, and they can immediately tell you whether or not it's located in a flood hazard area. Now, the benefits of using a realtor, they are representing you. If you don't have someone representing you, if you don't have an agreement with them, a buyer's agreement, they're not really legally representing you. So you want to ask for representation. You want to maybe interview more than one real estate professional. I happen to know a lot of realtors, and so I've kind of chosen the one that I like very much the best. But you're not locked in to using someone that you don't like. So interview some realtors, ask your friends for names of realtors. You could even ask JP, and JP will give you some names of some realtors that he has worked with, and then let them do their job. Ask them for the information, what is this neighborhood like? What's the potential for growth? What is the supply and demand in this area? Tell me about the market in this area. I need to know. And then stop and think. What do I want? Do I want to buy a new home? Do I want to buy a condo? Do I want to buy a townhome, an existing house, or a foreclosure? Maybe you're handy and you want to buy a fixer-upper. So benefits also of using a realtor is that they're going to be giving you comparable sales, and those are what we call comps that are downloaded from the multiple listing service that they belong to, and it shows you what homes have sold for in the neighborhood where you're wanting to buy a house. And so the realtor can give comps to you very, very easily. I would never ever sign a contract or make an offer on a house without the realtor proving to me via comps how much those houses have sold for. Now, people can say tax value. Well, tax value doesn't necessarily mean that that's what houses are selling for in the area. So we want to know what homes are selling for. What is the competition? What are they listed for? That's a good way to find out. And the realtor should be doing all of this for you. And then, of course, contracts that are pending. And they can give you a really great market analysis on the property. So your agent, your real estate agent, is going to negotiate the price, who pays for what, the timing of the option period, repairs, what stays, what goes. And I was just reading on the Texas Real Estate Commission website yesterday that they're changing the promulgated contract regarding the option period. Now, option period to me is a great protection for the buyer. I would never buy a house without a 10-day option. The reason why is because during that 10 days, you pay a nominal fee for it, $200. The more expensive the house, you might pay more on an option, and your realtor can counsel you on that. But that gives you 10 days from the day the contract is signed and executed to walk that house with a licensed inspector and determine whether or not you really want to buy that house. We've had home buyers that were under contract, but they just found a better house during that 10-day option, and then they get their earnest money back. And then I also wanted to mention that your real estate commission, that's not something that you pay. I'm going to make that very clear. The seller pays the commission to the realtors. Okay, so he or she has a listing agent that lists the property, and then you have your agent that is handling your transaction, and that they cannot charge more than a combination of 6%, which you are not paying. So if you walk into a sales office and on the weekend and you want to buy a brand new house, you could have a realtor with you, and the builders already add in the cost of the realtor's commission, because they want the realtors to keep bringing them clients, keep bringing them people who will buy houses from them. So you will not be paying the commission. So there's a lot of good reasons to protect you to use a realtor. Is it a buyer's or seller's market? So Ernest and I have been talking about this, and it's a very interesting market. According to Texas A&M Real Estate Center, we have an all-time low inventory of existing inventory. We like to see 6 months worth of inventory, but currently we have 2.6 months of available inventory in the state of Texas. So if you ask a realtor, are we in a buyer's or seller's market? They're going to say it depends on the neighborhood. They're going to say it depends on the price point. So that if you wanted to buy a house for $200,000, there's a shortage of those available affordable housing. So it would be more of a seller's market in that particular instance. What does that mean? That means you have more buyers that want to buy that house. So you want to maximize your potential for getting your contract accepted, and that you can do that by offering more earnest money. You can do that by having a very solid pre-approval letter or pre-qualification letter from a company like SWBC that has a great reputation with the realtors. Ridiculous offers, they can kind of offend the seller, so especially if you're in a seller's market. DOM, I wanted to talk about that, days on the market. Ask your realtor, what are the number of days on the market for this neighborhood? The average statewide is 64 days, that's really good. So, but there are some areas where the days on the market, it's harder to sell a house in that neighborhood. So that's a little number that they should readily be able to give you. So what are fixtures? They're items that are permanently attached or built into the home. And then there's contingencies upon obtaining financing. There's contingencies upon getting an acceptable survey or an appraisal. So the property has to appraise out. And in the Texas Real Estate Commission promulgated contract, it says, I'm paraphrasing, but it says, if the property doesn't appraise out for the sales price, you get your earnest money back. If the survey does not come out the way it's supposed to, if the neighbor has built a fence on your property and they refuse to move it, you don't have to buy that house. There's a contingency written into the promulgated contract that you have to obtain financing. So if you apply and you don't get the loan, you get your earnest money back. But you do have to try to get your financing. So if the lender asks you for your bank statement or your pay stub, you got to give that to them, or you're in violation of your earnest money contract. We did have a gentleman that was under contract. He'd signed the contract, but he refused to give us the documentation we needed. He lost his earnest money. Now, earnest money is amount of money that it is indicating that you're really serious about buying this house. So if you're getting your offers are not being accepted, you may want to consider increasing your earnest money, and it can be all over the place as far as a percent. Typically in a buyer's market, 1% to 2% is fine. When you start getting into a really hot market like we're in right now, 5 to 10% may be required. Now that earnest money is never ever written or given to the seller. The earnest money is held in escrow to a title company. Even if you're buying a for sale by owner, you don't want to give the earnest money to the owner. We had a gentleman that he was kind of innocent and he was talked into giving the earnest money to the seller. This deal fell through. The earnest money, the guy kept the earnest money when he shouldn't have. It was $2,500 earnest money. How much does it cost to sue someone for $2,500? Probably about $2,500. So be really careful about that. You can give your check for earnest money to your agent. Your agent will take the check to the title company and receipt the check and hold that money for you and apply it towards the purchase price, or apply it towards the closing cost, or give it back to you whenever the loan closes. So earnest money, always write that check to the title company. When do you take possession? You take possession when the loan closes. Now, if you're ready to move in and there's no one living in the property and the seller's okay with you moving in, they may lease it to you prior to closing. Or, maybe the seller isn't ready to move and you've already closed on the loan. You can lease it to them. So you'd have a delayed possession. So I'm going to talk about protecting you. Ernest, you have anything to say? You have such good comments.
No, I just want to let everybody know that just because you said earnest money doesn't mean that money goes to me. So that's a different type of earnest. That's earnest money, not earnest money. But yeah, I want to clarify that.
Thank you. Thank you. All right, so protecting you, you must read the seller's disclosure, okay? And this has been rewritten, and it's very, very detailed. The disclosure that the seller must complete is really important that you read it before you make an offer. If you have an agent, if you have a realtor that's not readily giving you the seller's disclosure, you've got a problem. You've got an agent that's not doing their job. They're just trying to get the deal closed. So what are you going to do before you make an offer? You're going to read the seller's disclosure. Anything that they say they're going to give you, you can have the refrigerator or you can have that painting or whatever, that has to be in writing or they're not legally bound to give it to you. I suggest getting an inspection and then also ask the seller, ask the agent, do you have any home warranties that go with this house? Home warranties that may cover anything from HVAC systems to pools, appliances. Now the seller's disclosure that I'm asking you to read with the fine-tooth comb is going to disclose any material facts that would affect your decision to buy a house. Does it have lead-based paint? Does it have asbestos? Are there any foundation issues? Are there any conditions or repairs that I need to know about? Is there a problem? Is there a swamp located in the corner of the backyard or a sinkhole or something? So mold, that's a big one that you have to tell people if there's been mold. And I did have a situation where we had a client that we made a loan to. He came to us and he said, I've got a check for $26,000 from the insurance company. We had a lien on his property, and the check's made out payable to the mortgage company and the servicer and to him. He wanted us to take that $26,000 that he had gotten from the insurance company because the insurance adjuster had deemed that he had $26,000 worth of damage from a hailstorm. He wanted us to take that and put it on the loan and apply it towards his principal balance. Of course, we did not do that. What I later found out was, I said to him, well, sir, what are you going to do about the damage on your roof? Well, there's nothing wrong with my roof. Then why did the insurance company give you $26,000? So that's why, just kind of relay that story. That's the kind of stuff people will try to do. I found out he was trying to sell his house. Now, what if he didn't owe anything on his house? What if he just owned it outright? He would have pocketed that $26,000 and he would never have told the homeowner about it. So people do things like that. And, I don't know how they live with themselves, but one thing you can do is you can call your insurance company and say, I need to know what claims, here's the address of the property I'm thinking about buying. Is it in a flood hazard area? Can you tell me what claims have been made on this house, so that you would have seen, the purchaser would have seen that this guy had hail damage. So then they would know, where's the new roof? And they can't produce the documentation on a new roof, then that is not good. If the seller tells you, I have fixed the foundation, I had foundation problem on my house, I've got the engineer's report, I've got the documentation to show that there's piers going down 25 feet. Your realtor, you say to your realtor, I needed verification that the foundation was fixed and when it was fixed. I need to know when the roof was fixed. I need that documentation, and they should be readily available, able to give that to you. So this is just what I was talking about. If there's a warranty, you want to ask for that homeowner's warranty. They're usually good for about a year, and then get everything in writing. As far as inspections, I would say that your agent will recommend 3 to you or give you a list. You do not have to use them. You can use any licensed inspector. Well, you can use any inspector you want, but you want to use someone who is licensed. You can check on with the Better Business Bureau, the American Society of Home Inspectors. You can make sure that they're licensed and ask exactly what they're going to inspect. Ask to see a copy of their E&O policy, their errors and omissions insurance. So in the state of Texas, if you're a licensed inspector, you must have an errors and omissions insurance policy in case you missed something, you got it wrong. The homeowner can make a claim on that E&O policy. Ask if you can attend. To me, I would just say I'm going to attend the inspection, because I want to see if I'm paying the money to have it inspected. It's not required, but if you're going to get an inspection, I want to know exactly what they're doing. And ask for references. Inspection's not an appraisal, but they're just going over the house with a fine-tooth comb just to make sure that the air conditioner is working, the heater is working, the water in the dishwasher, and so on and so forth. So they're going to go over the house with a really, really fine-tooth comb to see if there's any structural problems. Now, we want to make sure that from start to finish, you kind of understand the process. You get pre-qualified or pre-approved. Now, I want to tell you the difference between pre-qual and pre-approved. Pre-qual is where you go into the website and FSCU website, and you apply for a loan. And then JP gets your credit and gives you a yes or no. But a pre-approval is where you've supplied us with all the documents that we need to send it to an underwriter, and the underwriter has signed off on the loan. So just a little bit of trivia. It's great to have a pre-qual, but it's even better. Realtors like pre-approvals even better, because that means the underwriter has signed off. So you want to find a house, negotiate the contract. The agent is going to be negotiating your contract. Once you have a contract and a property, then JP can lock your rate. You're researching your homeowner's insurance, get the house inspected, which may trigger a renegotiation if the inspector finds a lot of stuff. And then we'll get the appraisal. The appraiser may have some required repairs. A lot of times the seller will just say, I'm not going to get this repaired. I'll just give you the money, or I will lower the sales price. Clear title, survey. With survey, then we verify your cash to close and your employment and your credit score, your ratios. So like Ernest was saying, you really don't want to change anything about your situation financially in a negative way, because we have to re-verify right before we close your loan. Now, if you opt to choose to receive information from us electronically, which I highly recommend, then we will send you a closing disclosure, a CD, 3 business days prior to your loan closing. And that there's no wiggle room there. I mean, we have to give you 3 days to look at your documents. And I actually really like this rule, because it gives you time to look at the documents and to see what you're signing. The way it was in the old, before was people just went to closing and then they just signed everything. They never really had an opportunity to look at their documents. So same information that you get in the loan estimate is going to be in that CD. So please be watching for your email on that. Now, there's a time lag many times from the time your loan closes to the time your first payment is due. Sometimes it takes a couple weeks to get it to the servicer up and running on their computer. So you will get a first payment letter that the escrow officer is going to give you. It'll tell you when to make your payment, where to make your payment, and when it is due. If you don't have a payment booklet by the second payment due date, then call JP and he can research what has happened. So trying to do a lunch class and kind of get you on your way quickly, but we want to thank you very much for spending this hour with us, and then open it to any questions we got any questions, Ernest?
All right. So, yes, Tammy. So we have some wonderful questions that our viewers have placed in the chat. So here, we're a team. So my team member now, her name's Eileen. She's going to read some of those questions, and I know you're going to help our members with some good answers to those questions. Okay. So go ahead, Eileen. I'll give the mic to you now.
All right, so our first question is from Shannon Parker, who asked, how does equity fit into PMI? For example, if someone is buying a home for $150K that is valued at $200K, do they still have to have 20% of the $150K to put down to avoid PMI?
No, I mean, if it's appraising at 200,000, she's talking about it's actually selling for less than what it's appraised at, then that you would have equity in that, and you shouldn't have to pay PMI. But I don't know that many times that really happens. When is someone going to sell you a house for $50,000 less than what it's worth?
Or if, for example, you have a $50,000 down payment, that $50,000 would allow you to avoid PMI.
Yeah. Yes, absolutely. Absolutely it would. Yeah. So 20% of 200,000 is 40,000. So if you put 50,000 down, yeah, that's a really good question. Yeah, you would not have to pay PMI.
All right, great. And our next question is, are there any considerations for second home purchases we need to know about?
There are, obviously we can do second home loans. I think JP is probably going to tell you that there's a larger down payment required, and maybe a little bit higher. I know the interest rate is higher on investment property. So, but we do vacation homes, second homes all the time, but they're a little bit riskier. So unless you're going to declare that second home is your homestead, you may have to put a little bit more money down, and the interest rate might be higher.
Great, thank you for that. So our next question is from Maddie Rounds, who asked, aren't there typically first-time home buyer loans as well? Do those have different qualification rules and typical down payment percentages?
They do. There's too many to talk about. So basically, the first-time home buyers, there's first-time home buyer programs in the city of San Antonio. There's first-time through the TDHCA, Texas Department of Housing and Community Affairs. So you can talk to JP about the different DPAC programs that there are available. He's very knowledgeable in all of that, but there are some first-time home buyer funds available for first-time home buyers. You just need to call JP and find out which one you would qualify for.
Great. So our next question, so we had another question about first-time home buyer programs. So you've already covered that, Tammy. And then our next question, I know this will probably be something that they may want to talk with JP a bit more about specifically, but Bernardina asked, What does your credit score have to be in order to qualify to purchase a home? I know that's a loaded question and probably not something that you will be able to answer, but
yeah, no, I
go ahead and
can.
pose that
I
to me.
absolutely can answer that. I can answer that. So in most cases, that's a great question. In most cases, the lenders have a minimum FICO, and they have minimum FICOs for different programs. Like if you were borrowing a large amount, they might require the FICO to be higher. But just what our company has as a rule of thumb is 620. So if you have a 620, then that should meet the requirements.
Okay, great. So our next question is from Maddie. Are there any cons to using a realtor?
I think that's a great question too, Maddie, because if you use a realtor and you are using someone that you don't enjoy or you don't trust or you don't like. When I bought my house, I was pretty young, and I probably would not even say hi to the realtor that I used because she didn't tell me about the seller's disclosure. Now that I'm older and I know more, I realize how much she took advantage. So, but most of them are not going to do that. And if you have a buyer's agreement signed with them, they legally have to be your advocate. So I think that you have to use a realtor if you're going to get access to the house. So let's say you're driving around and you see a house for sale in your neighborhood and you call the number. There's no way to see that house unless you deal with that realtor. So you're not paying the commission. I will tell you where you could not use a realtor if you're buying a house from just an individual and the individual says to you, let's just avoid the 6%. I will sell it to you at a lower cost. Then you may not need to use a real estate professional. If you use, and the question we got the other day was, what if I use multiple realtors? Like if I have 4 or 5 realtors working for me at the same time. You can do that if you don't have a buyer's agreement with one realtor, but you're not getting, they all know that you're not working with them. And so you may end up not getting help from anybody. So it's probably best, in my opinion, to interview 3 or 4, get some recommendations from people that you know that have bought a house, and let them know, I'm just interviewing you. I'm interviewing some other realtors, and then if it works out, then I'll choose you. But I don't really see a lot of downsides to using a real estate professional. I myself, as long as I've been in the business, I am using one, and it is a huge blessing. So I recommend using one unless you're doing a for sale by owner, and in which case I wouldn't bother with it.
Thank you so much, Tammy, for sticking with us a little bit over the time that we allotted. And also thank you to everyone that's still in the participating in the webinar. We have some great questions. So we're going to keep going through the questions, okay? Thank you, Tammy.
All right, yes, we've got a few more great questions. So our next question is earnest money in its own separate fund, or is it taken from the down payment?
That's a really good question. So it's separate from your down payment. So what the lender's going to do is they're going to verify that you have the down payment in your checking account, or that you have the funds, whether it might be, maybe you're going to have an investment account you're going to transfer. The earnest money is completely separate from the down payment. It is just an amount of money that you are giving to the seller that indicates that you're serious about buying this house. Now, it can be used for the down payment once you go to closing. But as I said, the typical earnest money can be anywhere from 1% to 2%. in a buyer's market could be 5 to 10% in a hot seller's market. So you take that money, write a check to the title company, and the title company is going to hold that in escrow for you until your loan closes. So it's separate, but it can be applied towards your down payment when you go to closing.
Great, thank you for explaining that. So our final question for now, unless anyone has any more questions, in which case go ahead and leave them in the chat. But our final question is from Maddie, who asks, can any insurance company pull up any claims submitted on any house?
Wow, we got some smart home buyers out there. That's a really great question. Typically they can. Typically, if it's in their area, they should be able to access it. So like if they're licensed in Texas, they should be able to pull up the claims in other areas. Now, if they don't do business in that area, they may not be able to, if they don't write business. Now, I'm going to tell you this is just because I think it's, it may be something that you encounter. There are some insurance agents that don't want to do that. They don't want to tell you what's in the clues report for whatever reason. And, but if you've been working with someone a really long time and you're paying the premiums to them and you're telling them, look, I want to buy this house. I'm going to get my homeowner's insurance through you. Can you please look this up? Now I don't think they will do it for you willy-nilly. So some will, but I'm told that that's a really good way to see how you can see the last 5 years, what claims have been on that home for the last 5 years. They're going to look it up when they write insurance on it. So they should be able to tell you. And if they won't tell you, I would move on to a different insurance agent, quite frankly. That's a great question. Is that it? No more questions?
Those are the last of our questions, it looks like. But if anyone else thinks of any questions over the next few days or once this is over with, or really at any time, we'll put Ernest and our mortgage loan originator JP's information on the next slide and in the chat.
All right, Tammy, so I guess you're controlling our slides here. So if you want to go to the next slide, that's my comment.
Okay, call it on the job.
So yes, for everyone that's tuning in, we do have another webinar going on as well on October 8th. Please sign up for that. We'll be talking about home improvement, and you'll be speaking with our in-house home improvement professional here as well. So we'll be talking about home improvement loans for those of you that currently own your home and you want to spruce it up a little bit as well. Thank you so much for tuning in. If you're still here with us, oh my gosh, you should give yourself a round of applause, a pat on the back, a hug, whatever. We just want to thank you so much for tuning in and staying past the 1 hour mark that we normally like to stay for. So tomorrow you are going to be getting an email from me. Once again, thank you for tuning in, but also selecting our winners. As you all know, we do give a $100 gift just for tuning into the webinar. So that one lucky winner is going to be announced on tomorrow. Please sign up for our upcoming webinars. And thank you so much. If you're currently not a member of First Service Credit Union, we would like to encourage you to join. We're going to put that information in the chat as well. And we will continue to bring this information to you throughout the year. And we hope that you really are getting some great information that's going to help you to improve your financial lives. Thank you so much to our guest, Tammy, for being part of this. Tammy, thank you so much. We really appreciate all the good information that you shared with us today. And we will be sending some people your way. As you know, a lot of people are interested in getting a mortgage right now. And we're so happy that you could explain this information to everybody. Thank you all so much. And to my team here at First Service, I can't do this alone. So we have a huge team that makes this happen. To our team here, I want to thank you, and everybody that tuned in for the webinar. Thank you so much.